With the stock market continuing to reach all time highs and volatility at all time lows, investors continue to pile into the stock market. In particular, are investors over the age of 55, whose share of ownership of the stock market has reached an all time high of just under 80%. The question is this appropriate for investors over the age of 55 who are nearing or already in retirement? Or is this a risk that needs to be addressed to avoid a major setback, such as needing to retire later, live on less, or return to work? Hi, my name is Ross Atefi. I'm the founder and senior wealth advisor at Yatra Wealth Design. And for over 15 years, I've been helping and guiding families and individuals get to and through retirement through a variety of various economic and market conditions. Now, as I mentioned, as you can see on this chart, the share of all stocks held by people who are age 55 plus has reached an all time high of just under 80%. And you can see that in the 90s and early 2000s, this percentage averaged somewhere between 55 and 60% and has really increased dramatically since then. Now, this chart doesn't tell us how much each person and each individual and each family has as far as, the percentage of stocks in their specific portfolios. It doesn't tell us that all people who are close to or in retirement have too much in the stock market, but it's a pretty shocking statistic. And if you're over the age of 55, this should really cause you to pause and consider a couple things. So, what is the risk level in your portfolio? And how much of your portfolio consists of stocks? What on a percentage basis? And to also analyze what the impact would be in the event of a stock market crash and how it could potentially impact your retirement income goals. See, as an individual or family who is over the age of 55 and getting close to or already in retirement, you have to both balance the risk of market volatility and downturns, as well as the risk of inflation over the long term. So, the risk of the cost of living going up over time. And there's no question that the stock market and investing in stocks provide a great hedge against inflation over time, as they, over the long term, can provide growth and gains that can outpace the rate of inflation over the long term and during most years and even decades of time. However, as you can see by this chart here, the stock market can also fall dramatically at turning points in the economic cycle, and in fact can take years or even decades to fully recover, especially when we adjust for inflation. And so, taking a look at this chart here, we're seeing specifically, downturns in the stock market, and the red here is the price of the stock market adjusted for inflation, and we're seeing that the chart is highlighting various scenarios where the stock market hit a turning point in the economic cycle and took a downturn. And these horizontal lines are showing how long it took in those various periods for the stock market to fully recover on an inflation adjusted basis. So, taking a look at this one here, it shows that it started in about 1931, and that was when we had the Great Depression. And in that situation, it took 27 years for the stock market to reach a new all time high on an inflation adjusted basis. Then we had the next, big downturn and change in the economic cycle happened in the early 70s when we had very high rates of inflation and an oil crisis. And as you can see here, the stock market took about 24 years to fully recover on an inflation adjusted basis and hit an all time new high. And then our most recent turning point was started in the early 2000s with the dot-com crash. And then, of course, in that period, we had the great financial crisis of 2008. And so, if you started from the year 2000, it would have taken about almost 15 years for the stock market to recover and reach an all time high on an inflation adjusted basis. So, essentially what we're saying here is that if you had been investing from the prior peak, let's say in the early 2000s in the stock market, you would have actually been poorer for 15 years. your stock portfolio, and you would have been poorer, whatever portion was in stocks, for 15 years before it hit a new all-time high. And these are just examples and reasons why we should be very careful to not go too high in our stock allocation when we're getting close to or in retirement, because it may take decades to fully recover, and in the meantime we have less assets to be spending on living in retirement. And the worst case scenario is that could cause us to have to alter our retirement situation. So we may have to retire later. We may have to live on less. We may even have to return to work, right? And so those are scenarios that we want to avoid. One way to potentially avoid those scenarios is to have the appropriate investment into the stock market, so that if we do see another turning point and big downturn, it doesn't take years or decades to recover. So to avoid this being an unfortunate scenario for you specifically, I believe it's really critical to sit down with a financial expert and create a retirement plan that's customized for you. And this plan should also include a customized investment strategy that provides you with the highest probability of long-term success in retirement, and that addresses the potential impact of a sharp downturn in the stock market and a scenario where the stock market could take years or decades to recover. So you have a plan just in the event that that does take place. Fortunately, right now, there's actually a variety and a number of various economic and investment opportunities where you can earn great returns without having to take all the risk in the stock market. And this is important because I think we're getting closer to one of those potential turning points in the economic cycle. And no one knows exactly how that will impact the markets, but it's certainly a good time to be a little bit more careful. And the fact that people over the age of 55 have such a high ownership of the stock market tells me that there's also the potential for a lot of people to sell all at once, because the people closer to retirement are going to be a lot less willing to ride through a major downturn in the stock market. And so there could be a lot of selling pressure all at once. So if you're interested in taking a look at your portfolio and your long term plan and creating something that's customized to you that will give you a high probability of success over the long term, please reach out to us. Please leave a comment below. Please like and subscribe this video so we can keep making more content. And I hope to speak with you soon. Have a great day.